although China now economic performance suffered a lot, however, they still have confidence for tomorrow.
China has detailed plans which will have it ending up as the world's #1 economic and global power again.
I thought we might just start by reflecting a little bit on the state of the world economy as Martin described. And I wonder, Mr. Cao, whether you might want to start and tell us a little bit about how you see slowdown in growth in China and far more generally, China's rise and its place in the world economy and the world political system as well.
Mm-hmm. As Professor Martin, for instance, showed, now the world is in reshaping, and China is one of the major factors. Last year is the very year Chinese, for the first time, worried about globalization. Mm-hmm. Since there is a Sino-US trade war, and it hurt China very much. Mm-hmm. As Martin has mentioned, China was adopted export-oriented economy. Export plays a very important role in China's economic growth, and US is the big market. So if we say worried about globalization or deglobalization, and last year, China followed very much, since it is a very big war. However, we understand, we think there is a solution. There is a compromise. Because this is not a national revival. It is something around the consumption center from change from the US to the China. Last year, you can see the consumption for the first time in China surpassed US a little bit. Mm-hmm. So if this market is open to the world, then in this way, China defended the globalization. And last year, you can see China adopted several policies. First, to encourage import. And in Shanghai, they have a commodity fair for the first time for import. They reduced the tax, reduced the tariff, and they opened many sectors, especially service sectors, as well as the financial sectors. Now, any financial investors can set up any financial institutions in China freely. Besides, they announced to open the market, capital market for the financial investors. So by doing so, you can see if China is an emerging market, and China is a large country with the 1.4 billion population. 10 years ago, we announced all wealth society. Mm-hmm. And according to this plan, they said within 10 years, that is from 2010 to 2020, the GDP doubled and the personal income doubled. And this year is the key year for this program. If with the last 10 years, China's GDP doubled, personal income doubled, this is a new China, and this market is very big. The potential market opens the world, then everyone can enjoy China's development. So this is the idea for China. I think although China now economic performance suffered a lot, however, they still have confidence for tomorrow.
So you are expecting that there will be an agreement?
Yeah. Last year is the 40th anniversary of China's open door policy and reform. Mm-hmm. For the last 40 years, you can see nearly 300 million people now reach to the middle income, high income. Another 900 million people just, near the middle income. And according to China's plan, in the next 2 years, all the poverty will be eliminated. Then, this is the potential of China's market. I think consumption, demand, become the strong driving force instead of investment, instead of export, become a new forces of China's economy.
I'd like to come back to you a little bit later to talk about the Belt and Road Initiative. But let me move to Sir Gerry. I could ask you about Brexit, and I would like to hear your thoughts on Brexit, but perhaps for this audience, what may be just immediately more relevant is Martin described the state of the global economy and the trends going forward. How would you position this region?
I mean, first of all, we have to say to ourselves that we are living in a time of huge global uncertainty. We have new features in politics, we have populism, we have the politics of rage, and we have some very, very large things happening in the world. Just coming back a moment to China, I've been over 200 times to China. I try and go once a month. And I'm always struck when I'm in China of the significance of the year 2049. Because by 2049, the 100th anniversary of the founding of the Chinese state, China has detailed plans which will have it ending up as the world's #1 economic and global power again. And the Chinese think this is necessary because they believe the last 500 years were an aberration. So an historic anomaly has to be corrected. And of course, that is what America is looking at. And I just see the China-US trade wars as a manifestation of a global power play that is going to play out over the next 10, 20 years. Maybe sometimes better, maybe sometimes worse.
Does that not offer, in some ways, an opportunity for a region like the Middle East?
Oh, I think it does. I think this region, if it can organize itself better than it has done traditionally, has tremendous opportunities. In the rest of the world, you've had a collapse. You're having a collapse of multi-lateralism in favor of the rise of the nation state. And we should remember that most multilateral organizations were set up after the terrors of the Second World War, where people decided they would come together as nations. They would subdue some of their natural animal instincts. These organizations often fueled by American generosity, and America itself agreeing to stand back a little bit and not exercise American power. We're now in a time where America, and I can understand why, is fed up with being so generous and is slowly pulling himself out from these multinational organizations. I think for the GCC and for this part of the world, I think working together is going to be of primary importance going forward.
You mean the whole GCC working together?
The whole GCC working together. I mean, for example, look at the UAE. I think it's great that we're now seeing the emergence of a banking strategy emerging in the UAE with the recent merger of the banks. I sit on the board of the Abu Dhabi Commercial Bank, and I much commend what is going on there behind the scenes in terms of banking strategy. I think there's huge opportunities here for investing in the infrastructure in the region. Parts of this region are well served by infrastructure, others absolutely aren't. And I look at the experience there is elsewhere in the world, in the City of London, and I think there's real opportunities now to use private capital to couple with local knowledge, to have a massive expansion of infrastructure in the region. And all this is needed because the world, as I said earlier, is very uncertain. And what lessons do you learn from the past? when the meteorites hit the world and the dinosaurs went extinct 10 billion years ago, who survived? It was the organizations which were able to adapt to those very severe changes. And I think for CEOs and chairmen, the key skill over the next few years is going to be adaptability, because we are going to be faced with challenges that we have never seen before in our business lifetimes.
Thank you for that. Sammy Kayello, you're a board member of Morgan Stanley Saudi Arabia, so I think it would be interesting to hear your thoughts about the business climate today. Obviously, over the past year, the perception of Saudi Arabia changed quite massively. Is business resuming after the Khashoggi affair?
Thank you for inviting me. Yes, business is resuming. It's not resuming to the same rhythm that it did before the events of last year. Saudi Arabia is going through a sort of socioeconomic change, financial regulatory change, a sort of political change, and trying to put all these to work within a deadline of Vision 2030, which is 10 years, in itself is quite a challenge. The business before the events of last year was that there was a lot of interest in the region and Saudi. The region and Saudi are extremely attractive from, as much has been said today, from a demographic standpoint, from infrastructure, from untapped potential, and so forth. And plus the attraction that most of the currencies in the region, or in the GCC at least, are all pegged to the dollar. For the largest asset pool that's investing in the world today, the currency risk isn't there, and so on. But subsequent to what happened is there's been a bit of a pullback as some of the long-term money is looking for stability, safe havens, is looking for ESG, environmental, social governance, and so on. And some work needs to be done to get the confidence to return to where it used to be before.
It has the interest mostly been in sort of tapping Saudi contracts, or rather getting Saudi Arabia to invest abroad more than in attracting FDI?
The interest is multidimensional. It's foreign money coming in, FDI coming into the country, whether it's coming through the financial market or through partnership or infrastructure and so on. It's local money going out and looking for ideas and boots on the ground in return for the investment that it makes, and local to local money that's happening. Some of the consolidation that's happening in the market is fueled by both money from outside and locally. And as the market opens up, and as Saudi is just joined FTSE EM and joins MSCI, you should look for more money to come to the region. And that passive pool of money is pretty substantial and is likely to come to the market and will be less sensitive to the geopolitical dimension that surrounds the region.
Okay, thank you, Sammy. Sunil, as Martin described, we are living through a slowing growth environment with a lot of geopolitical risk. How does this environment affect Standard Chartered?
So we are slightly more positive in terms of the outlook. You probably saw Martin's presentation, which was very clear. If you see the growth pockets, Asia is going to drive growth in future. This region is part of Asia. And the second one in terms of demographics, urbanization, is Africa. So we are, I think by history and by just our presence, blessed by the fact that we are in Asia, Middle East, and Africa as our core markets. And we believe that global growth possibly would settle at around 3%, not 3.9, which was last year, so slightly lower, but still a pretty decent growth rate, which will help fuel consumer activity as well as investments. One big trend which we are seeing is clearly connecting pools of capital which are sitting in the developed world, looking for better returns. As you saw, interest rates going off, looking for better returns in the faster growing markets. And that has implications for wealth management as pools of capital look for higher returns. It has implications for debt capital markets. So if you look at the issuances that are coming out from this region, Middle East and Africa, big pockets of investors coming out from Asia, for instance, from the East. It also has implications in terms of project finance. Mr. Cao spoke about China, but China has been a big investor in building infrastructure in Middle East, but more particularly in Africa. I say Middle East because the single largest one belt, one road investment, a $62 billion slug is actually in Pakistan, which is part of our Middle East portfolio. So we are quite optimistic in terms of the structural growth, the growth rates being quite attractive, the demand for capital being quite high, and being able to connect those pools and the demographics and urbanization supporting this in the foreseeable future. So we are cautiously optimistic despite some of the headwinds.
Do you see much impact on this region in particular from the US-China trade war?
See, I think there are two big things we need to watch out for in the immediate term, which is in the next few weeks. One is, we call it the two deals. One is Brexit, the other is the China-US trade war. Now, both of them have a disproportionate impact on sentiment to start off with. I think if both go reasonably well, and it's difficult to define what reasonably well is, but if they go reasonably well, I think global sentiment is going to go a couple of notches up and stabilize. The trade war, one can always say that it has implications and it has a rationale which goes beyond just, import of soya meal or export of LNG gas. It probably has more strategic, and some of the underlying tensions will continue for several decades to come. But these two we are very closely watching. There is no immediate impact, but it will have an impact on sentiment, which will percolate down to, I think, commodity prices. So it will, in that sense, in a macro sense, have an impact.
Thank you. Shayne Nelson, it's always been said that Dubai benefits from troubles in the neighborhood around it because people seek stability, business seeks stability and certainty. Is this still the case, or do you now think that between the tensions with Iran, the tensions with Qatar, and the broader issues, that Dubai is feeling the pressure today more than it did in the past?
I think if I look at the UAE, not just Dubai, and even Saudi, I think one of the effects we are getting economically flows from the peg. One of the things we're getting an effect of is the peg. Now, we're basically now a dollarized economy. And please don't think I'm saying let's break the peg, but I'm just saying why this economy feels slower. We have a peg currency. We're following US interest rates, and that's fine if your economy is in sync with the US, but we're not. And I think that means that our wages are in dollars, and we're competing against a lot of countries around the region that are depreciating their currencies against the dollar and therefore the dirham. So I think you're feeling that effect flow through the economy when it comes to competition. Even if property prices remain stable, if you're an Indian, they've gone up 10%, et cetera, et cetera. So I think we are seeing Dubai as a place at the moment that feels expensive for tourists. for investors. So I think we are going through that shift where I think largely the currency is hurting us. Now, do I think over the medium term that'll right itself? Yes, I do. But at the moment, I think we're in a situation where the economy is being hurt by the strength of the dollar and therefore the dirham, and that leads into a lot of competition issues for us in Dubai itself.
Okay. If we go back to China, I'd be interested to know what are some of the projects in this region in particular that China is interested in. The Middle East is part of One Belt, One Road.
One Belt, One Road. Yeah. One Belt, One Road is initiated by China 4 years ago. It consists of about 65 countries. We are known by 5 connections.
It's even
infrastructure, trade, finance, policy, and people. Yes. But in China, it is not related to the material issues. It is also the way Chinese to look at the world. It is related to the, the outlook of the world. What is One Belt, One Road? China said it is a spirit of Silk Way. What is the spirit of Silk Way? 3 commas. He said, number 1, consultation. Number 2, contribution. Number 3, shared benefits. I think this is the very Chinese way to look at the world. Represents Chinese philosophy, 弥头吧. They said dialogue is better than conflict. Anything can negotiate. Anything can reach compromise. That is the spirit of the Silk Way. That is what we call consultation. For the contribution, that is the experiences of the 40 years Chinese experiences of reform. To make the cake bigger, lay down the basis to solve the problems. For the One Belt, One Road, many countries are still developing countries. Economic development is very important. The last 40 years, China's experiences is essential. Just one word. Development is everything.
Does political influence not come also with development?
Yeah, of course. If the cake becomes larger, then you can solve the instability of the political, poverty, and even terrorism, we believe. Number 3, of course, the cake should be shared by all the partners, so shared benefits. So that is related to the international governance. So not only an issue of region, but related to the international governance. So that's why, we think maybe by doing so, we can build up a better world. So that is the initiative. From the economic view, I'm a banker. I think one of the most important things is renminbi international use. So you can issue the bonds in China, what we call panda bonds, then you can take the money to build here. That is the infrastructure, financial support with that financial connecting. And then China's market, capital market is opened. The bond market, you can invest freely, especially by renminbi. And of course, the trade settlement, you can use renminbi. And I think this is a new source for One Belt, One Road countries to raise money.
Okay. Thank you for that. So, Gerry, I think a member of the audience is insisting on your views on Brexit and how it impacts banking and finance.
Let's be straightforward. Brexit, the way it's been conducted, has been an unmitigated disaster for the United Kingdom. I am as knowledgeable as anybody can be in the UK about what might happen over the next 2 or 3 weeks. And nobody knows what is going to happen over the next 2 or 3 weeks. And for a major country, despite the hard work of all concerned, to have got itself into this position of unpredictability has to be said to be a bad thing. Now, why are we in this position? It's because 2 years ago, it wasn't really recognized properly. This was not a technological negotiation about technological customs and excise arrangements. This should have started off as a political negotiation 2 years ago as to what was the nature required of the relationship between the United Kingdom and the European Union in the years to come. Many people I know now are taking an almost a bipolar attitude towards this. They would either rather stay completely or they would rather leave completely. And this myth that there is a halfway house between staying and leaving, which gives the advantages of staying and the advantages of leaving, the last 2 years have shown that that myth does not exist. I personally think that if this vote goes badly tomorrow in Parliament, we are going to be faced with almost the essence of a constitutional and a political crisis in the United Kingdom, because we will have a government who is committed to wanting to do something and a Parliament which will not vote for it. And the traditional solution for that in Britain has always been a general election. I think the cards at some point, the political cards, will have to be reshuffled. And I think it is quite likely, I'm being braver than Martin and making some predictions, I think it is quite likely that there will be a period of crisis in the United Kingdom. I think it quite likely that period of crisis will be followed by a general election. And I think it quite likely that general election in due course will be followed by a referendum on whether Britain stays in the European Union or leaves the European Union completely. And as I said before, the idea that there's a very nice kind of lounge you can sit in the middle where you're both in it and out of it and having the benefits of both, I think has been exploded as a myth in the negotiations that have taken place over the last 2 years. Was that forthright enough for you?
Absolutely. I didn't expect anything different, Sir Gerry. Sammy, let's look again at some of the geopolitical risks in the region, and I want you to address a question similar to the one that I asked Shayne. To what extent do you think, for a long time, I think Dubai and the Emirates in particular, we've always thought of them as being quite insulated. To what extent do you think this is true today?
Can I just make a quick remark on the Brexit thing? We travel around the region, we talk to our clients about Brexit, and interestingly, they're not so concerned whether the UK stays in or pulls out or what happens. The biggest concern institutional clients in the region have about Brexit is the vote turning after the outcome, whatever it is, from the Conservative Party to the Labour Party. That for them is a very profound...
You mean the Corbyn factor?
Yes.
Yeah.
With respect to the question you asked me, when we look at our business in the region, when I look at what we're trying to do, and over the years, the three most profound factors that have impacted the wallet and the way we go about business and how we execute have been geopolitics, have been the price of petrochems, hydrocarbons, given that most of the region is kind of a single one or two commodity region, and finally the pace and direction of financial regulation. If you go back to about 10 years, the pillar of these three that has really defined what happens and how we went about hiring, how we grew, we shrank back, and so forth, has been geopolitics. We can forecast prices of oil, LNG, gas, whatever, we can partner with regulatory authorities in the region, but we are reactive to the geopolitical dimension. And in relation to your question specifically with respect to the UAE, in the final iteration of the geopolitical development, it seems that there's been some contamination risk to how we go about attracting those that are not informed about the region. There are a lot of sophisticated investors around the world that can distinguish between each of the countries in my remit, Middle East, North Africa. One by one, they're experts, they have internal research, they divide and conquer and try to understand where to allocate and so forth. But those that are less informed, those that are looking to new frontiers, to whether it's frontier markets developing, EM, and so on, tend to sort of lump sometimes the UAE with the rest, and whatever is radioactive tends to contaminate it. And then it's our job to try to row back and educate and inform and distinguish, because that in a way does create opportunity. If you discount something, then obviously you're probably underweight, unexposed, unwilling to consider opportunities and so forth. And being able to move the dial on that, to be informative and so on, is an opportunity. I'm trying to be positive on it, but if there's one thing for me to look forward in the next 5 years,
yes,
is for that aspect of the three things I talked about to just sort of fade away a little bit so that we can go back to work, all of us, and do what we try to do.
Thank you, Sammy. Sunil, would you like to come in?
If I could just add, I think it's easy to get very, very kind of gloomy about the outlook in the region, but there are few secular themes that we need to keep in mind. One, the diversification from the oil and gas, which is the upstream to downstream and value added. If you look at any of the Emirates, or if you look at, any of the GCC members, that's a big theme. And that's going to have implications in terms of investments. It's going to have implications in terms of economic activity. What do I mean by that? Investment in refining capacity, investment in downstream chemicals, investment in value-added industry. I think that's going to be very, very important. And these are running into billions of dollars. There is a geopolitical overhang. There's an expectation that over the medium term, those will get resolved. That's something which we don't control. But I think in terms of the economic activity, that's going to be very, very important. The second thing is the competitiveness created in terms of an aviation hub, trade hub, tourism. Those don't go away. Those sectors are still there. They have a growth prospect, and we are quite optimistic looking forward.
Shayne, I wonder if you could address the labor market. One of the big changes that I see over the last few years is there used to be, generally in the GCC, a great reliance on expatriate labor. And in the last few years, there have been much more concerted efforts to train and to promote local labor. To what extent do you think that has been successful? And has it had that much of an impact on the desirability of the GCC in terms of expatriate interest?
Yeah, I think that's a very good question. If you look at Saudi, and if you look at the demographics, you've got more than 50% of the population under 25. Oil doesn't create jobs. You need to push your agenda when it comes to Saudiization there. You need to actually diversify your industry base. So I think that if you look at Oman has been pushing localization for a long time. The UAE, in the banking sector, we have nationalization targets, but we've had those for a long time. So I think if you're not prepared for it, it's your own fault, because this has been around for decades. But it is getting tougher to get work permits in places like Saudi Arabia. Certainly getting approvals even in the UAE for some banking jobs. The central bank wants to localize. It's pushing point score on localization. So I think for us, it's about preparation and training locals. And at the end of the day, the finance industry has some of the most attractive jobs, and therefore it's a very likely push. It'll be harder into the financial sector than anywhere else.
Thank you, Shayne. I think I'm just going to take one question. I think there was a question down there, the gentleman on the right side.
Thank you. I would just like to ask the panel to comment on the point that Martin made regarding globalization, particularly from a regional point of view. Dubai in particular is sort of set up as a hub to serve an ever-growing globalized world. So I'm wondering, he had a fairly negative outlook for globalization as we've seen it in recent decades. I'm wondering what your view is on his comment and what it means for Dubai and the Gulf.
I mean, I think we will still see globalization, but I fear it's going to be driven by bilateral arrangements as opposed to multilateral arrangements. I mean, I think everybody in this audience is global. Everybody's businesses have sort of tentacles around the world. But I think increasingly that will be struck on a country-by-country basis. Because I said earlier, the rise of the nation state is acting against the operations of multilateral organizations. In my companies, I keep our globalization going by constant interaction with the countries with which we're doing business. So I go to China once a month. I go to India every 6 weeks. I'm in the Gulf every few weeks. I'm in the US. But globalization, I fear, is going to be built through those contacts. Globalization will continue, but it will be harder work to make it work, perhaps, than it was previously.
Please join me in thanking our panel. Thank you very much for being with us.